Hi everybody! Here's something that'll blow your mind. Two IT giants, TCS and Infosys, almost identical PE ratios. Two auto giants, Tata Motors and Mahindra, PE ratio differs by 3 times. Both pairs compete in the same industry. So the question is, what's the secret? Understanding PE ratio isn't just about crunching numbers, it's about reading the market's mind. And by the end of this video, you'll understand exactly what the market is telling you. Now, before we dive deep, let's understand the basics. PE ratio, or price-to-earnings ratio, is actually very simple. It's market price divided by earnings per share. So if a stock costs 100 rupees and the company earns 10 rupees per share, the PE is 10 times. Think of it like this. Imagine buying a small shop for 10 lakhs rupees that makes 1 lakh profit every year. You're essentially paying 10 times its annual earnings. High PE? The market expects growth. Low PE? Either the stock is undervalued or the market sees slower growth ahead. Simple, right? Now let's look at our first case study, TCS and Infosys. On the surface, they look almost identical. TCS has a PE of 23.3x, Infosys at 23.9x, barely any difference. But here's where it gets interesting. When you look deeper at operational efficiency, TCS's ROCE, return on capital employed, is 64.6%. Infosys, just 37.5%. That's nearly double. So the lesson here is crystal clear. Similar PE doesn't mean similar efficiency. Investors are willing to pay the same multiple for both because they're both industry leaders. But, and this is important, TCS is delivering far better returns on every rupee of capital invested. This is what separates good companies from great companies. Now comes the shocking part that most investors completely miss. Tata Motors trades at just 11x PE. Mahindra, a whopping 33x. That's 3 times higher. Now the question is, why would investors pay so much more for Mahindra when both are in the exact same auto sector? Well, here's the answer. Mahindra is seen as a growth story. SUV market dominance, aggressive EV strategy, strong brand perception. Tata Motors, the market sees it as a value play with execution challenges and cyclical risks. Same sector, same competition, completely different investor confidence. This is the power of market sentiment. Now, here's what the market is actually teaching us, and this is gold. IT companies, on average, trade at 27.4x PE. Auto sector, just 20.3x. And there's a brilliant reason for this. IT is asset-light with global market reach and predictable cash flows. You build software once, sell it 1,000 times. The auto sector, it faces cyclical demand swings, heavy capital requirements, and regional market challenges. Raw materials, factories, inventory, all capital intensive. So smart investors don't just compare PE ratios blindly. They understand the story, the context, the sector dynamics behind those numbers. That's the difference between amateur and professional investing. So remember these 3 golden rules. Number 1, similar PE doesn't guarantee similar investment quality. TCS versus Infosys proved that efficiency matters more than multiples. Number 2, sector context is everything. Don't compare auto PE with IT PE blindly. And number 3, growth perception beats current valuation. Tata Motors versus Mahindra showed us that market confidence determines the premium. Don't just look at PE ratios like robots. Understand why the market values companies differently. That is the secret to intelligent investing. Drop a comment telling me which stock you would pick, TCS or Infosys, Tata or Mahindra, and subscribe for more such deep dive stock market case studies. Thank you so much for watching. I'll see you in the next one. Bye-bye.